Hey guys, today I want to cover how crypto trading bots are making massive profits even in a down market. Now I know a lot of you guys have experienced the pain of seeing your portfolio just slicing in half, then by another half. And the last thing you want to do is even tune into what's happening in the crypto world because it's too painful to watch. I've experienced this myself. But in the quest for me to really get to know who are making a profit. When there's sellers, there are buyers. So in this presentation you're going to see today is going to be an eye-opener. And I first want to relate back to chess. In 1966, it's the first time that we have the champion, world chess champion, happened to be called Gary as well, Kasparov, and he versus the machine that I think it was IBM that made the machine. Is one of the most powerful computers. It's called Deep Blue, and Deep Blue, after an epic battle, lost to the world champion Gary. The year later, 1967, it had a rematch after certain tweaks in the computer. The first time ever a computer is able to beat a human being in chess. And over the next few decades, it's kind of like went back and forth, and sometimes the human will win, sometimes the computer will win. But as the computer chip processing power got smaller and became more powerful over time, around 2005, 2006, the computer started taking the lead. And so in today's world, they don't even try to match a human with a computer because they know a human doesn't even stand a chance. There's no way the human brain can analyze so many different scenarios in a fractional amount of time that a computer can. Especially with AI technology that can learn as you go. And these days, the only chess tournament with computers are one computer software running a chess program versus another chess program and see who wins. But the only problem with that is it tends to battle on forever. And the only way for that to stop is when you pull the PowerPoint and unplug the power. So, which leads me to sharing about when I looked into during the dot-com crash, who are the top funds that are still profitable, where most other hedge funds, most other traders are taking a massive beating. In fact, during the dot-com crash, the Nasdaq dropped by an all-time high of 76%. And from that, there are funds that are largely using bots, quantitative bots, algorithmic bots, that are making a very, very substantial double-digit returns, which I'll get to. So this is an article in CNBC saying that JP Morgan says just 10% of trading is just from regular stock picking. The rest is from bots. So quantitative investing based on computer formulas that trading by machines directly are leaving the traditional stock picker in the dust, now dominating the whole equities market, which is the share market. One of my favorites mentor, he doesn't know me, but I've been learning about him, especially in the funds management world. Ray Dalio, he runs the biggest hedge fund in the world, Bridgewater. If you don't know him, even countries get him to invest. Presidents get him to invest, kings get him to invest, and he stopped some of the top funds, which I'm going to be covering. A lot of them have stopped taking on new money for a long time. Some of them even push out the investor money. So with I think it's around $156 billion, making Bridgewater many times bigger than the second funds out there. Ray Dalio is the founder. He recently wrote a book called Principle. It's a great book. Not just in business, but in life. So Ray, in this article, he says that if you don't have a GPS, which is the trader doesn't have a GPS, which is a supercomputer, that have very smart software analyzing the big data, there is no way that you can beat someone that has a GPS. And he's got a famous TED talk that also go in a lot of depth about around this. Another article, The Rise of the Billionaire Robots, how algorithms have redefined hedge funds. The 25 best paid hedge fund managers pocketed $13 billion in 2015, and most of the big winners relied on programs, not contacts, for their big wins. It used to be you either need to have insider information or contacts in order to pick the right company or get into invest in the right company. These days it's more from quant algorithms. If you look at the rise of the quantitative funds, the bot-driven funds, versus the one that's like kind of like the Warren Buffett style, just picking based on fundamentals. Those have taken a massive beating over the last 5-10 years, and the ones that based on algorithms are steadily increasing in their profits. So in this article, it talks about the guy who are still making money hand over fist are doing so using not their own brains, but computer models. 8 of the 10 top earners on the Alpha List falls into that category. Alpha List is basically the top hedge fund earners in the world. Gene Simons at Renaissance Technologies, who holds the distinction of being the only person to appear on the list 15 years running. And he runs a very successful quantitative trading firm as well. The rise of the artificial intelligence hedge funds with AI, deep learning. If one fund achieves success with AI, the risk is that other people will duplicate and undermine the success. Finance is a domain where you benefit from not just being smart, but being smart in a different way from others. That's why a lot of people, all these quant funds are the deeply guarded secrets on what they do and how they do it. The rise of AI and algorithms in the financial services sector. Realtor estimates that algorithm trading systems, 75% of volume from the global trades worldwide is coming from bots. Algorithms, especially those focusing on risk management, are able to simulate thousands of risk scenarios within seconds. Banks used to employ technical and analysts to spew out loads of charts and levels. Only no one remaining in his contacts. And one of this article just really blew my mind away of what is possible. Now we've looked at what is the possible upside and can make a lot of money and can evade the .com crashes as well. But there are certain strategy that you can also not make loss. This company, Virtu, in 5 years of trading, it only had one losing day. And that was due to human error. And another one of his competitor called Trading Bot from Dave Cummins, in 4 years, it's never made a single day of loss. You don't normally hear about it because they don't declare the results. If you have a holy grail that you've gotten onto, you don't tell people. Because otherwise then other people are just on the same path as you, especially when there's no new liquidity coming into the market. Finance and trading is a zero-sum game. It's like going to a casino. Someone have to lose. And these guys are making massive profits in many different ways, which I'll get to. Citadel is one of the first company when it started quantitative trading, high frequency trading. They're really great at the area. During the .com crash, as I covered earlier, that was a massive beating in 2000. In 1998, Citadel made a 25% gain. In 1990, it made a 40% gain. In 2000, the year the crash happened, it made even a more significant gain, 46%. So that's why the topic of this is how do we profit using bot in a crash, in a down market? And can it profit from an up market? Definitely. But it's not market dependent. How do they do it? Man, I'm not from the trading world. And if you try to Google stuff, there just isn't any materials out there that talks about how to do it, because it's such a guarded secret in this trading world. And this book is started to shed some light into it. One of the story was saying that one of the guy that used to have like top level clearance at the Pentagon, and is a keen that when he was working at Citadel, where in the Pentagon he needed 2-level access to get to the top, now he needed 5 level of access, even more secure than the Pentagon. And so for me to learn some of the things that I'm sharing with you, I needed to just consume a ton of books and talk to a whole bunch of people, to learning from computer scientists, mathematicians, and other traders, other people who are smarter than me. I'm like the dumbest guy in the room. That's how I started to really understand a lot of these things. So another article, Bloomberg covered that the medallion fund that we've talked about earlier, which it used to open for public, and then now you can't even put in if it's just open for employees only. It's the blackest box in all of finance. If we look at for pretty much the last 19 years, every single year it's made a gain, except for 18-9, it made just a 0.5% of a loss. Now, on average, it produced around 35-40% gain on average. That's after fees. Same as the ones that before as well, Citadel I mentioned, when they're making 46% in the .com crash, that's after a 20+% fee that they've taken. So with Renaissance, their fees are normal hedge fund fees. They go with something like 22 model, which means that they take 2% management fee, which is like an admin fee yearly, and 20% only if they make a profit for you. With the medallion, not charging 2%, they're charging 5% admin fee. And instead of 20% on profit, they're charging 44% profit. But yet, they're still making 35-40%, especially during the financial crisis, where a lot of people lost like 50% of their super, their retirement savings. They are significantly up even after the fees. So how do these guys compare to Warren Buffett? Well, if you compare Renaissance compared to Warren Buffett, and Warren he's an idol that I look up to. The Australian Financial Review says, while it is fashionable to be a value investor, punt on a handful of heavily discounted stock, which is Warren Buffett's approach, that might eventually come good, a statistically superior style is often the trader that can regularly identify more ephemeral mispricing or temporary valuation errors that can be exploited over and over again. And the hedge fund make 2.4 times more than Buffett. So the secretive hedge fund had delivered an extraordinary compound average annual growth of 40.6%. This article, I think, was at 2016. So 40.6% since 1988, which is 2.4 times more than Buffett. And Renaissance had only one negative years. Warren Buffett has 6. And Renaissance only had 2 years, including the one that it lost money, that they performed less than 21% after fees for the past 3 decades. That's crazy, right? So you look at the charts, it's the more you look into it, the more it's like, how come nobody told me about it? Because they don't want you to know. The more that people know, the more people that can do this, the less money they make. This hedge fund may be poised to create the most billionaire. Again, more Renaissance creating another billionaire. One of the founders or one of the early person that's involved is now valued at $4 billion, largely due to the medallion fund. So how does all this relate to the crypto market? Now, using Bitcoin as an example, I just taken this screenshot just in the last hour. Once you know what you're looking out for, you see that for pretty much a whole day, the Bitcoin price has been pretty steady until around 10:15. There's a big spike in the demand, And I can tell you, when you got abnormal spike like that, which has gone up by $100, is from bot. The bot analyzing certain trade pattern, volumes, and whatever other signal decided to buy. And it could be multiple bots from different people that's triggered to do things at the same time. And since like pretty much like the late 2017, the crypto bots has been prevalent in this space. And then subsequently, after it reaches a certain level, there's a big dip. There's a big dip in place and then further push down. So if you normally do the buy signal once you get to a certain point and do certain stop losses, there are bots in place to clean you out, decide that that's designed exactly to trigger your buy and loss, so that you are, when the market is about to pump, it'll just trigger you to sell your stuff for cheap, and then so that it can go on a massive run. But at the same time, if you don't put those stop losses in, what if it keeps driving the market down? So, and you can't be there 24/7 like a bot can. A bot can stay up 24/7. That's the advantage. The bot is also, it is governed by a set of rules without fear or ego, which is the biggest weakness of a human when it comes to trading. We have emotion. We have our reptilian brain. We all understand that buy low, sell high, but very often it's the opposite. And the bots is designed to generate certain signals, even for all the chart readers that thinking that, okay, well, when it gets to this point, it's reached the bottom, the bots is designed to manipulate or to fool you to thinking that, hey, now it's gone to the bottom, again, to clean you out if you don't know how the game is being played. And that's the whole definition about smart money and dumb money. Smart money referring to people that knows more about how to play this game. Imagine you try to play a game of basketball and you've never dribbled before, you don't know the rules, versus someone that knows how to dribble, that knows how to shoot, that's been playing for the last 10 years and extremely good at it. You have no chance. So if you go to YouTube and want to see some live bot in action, there's a bot basically scheming profit, artificially pushing the prices up each time that you want to make a trade. Like I've experienced that myself, and once you see this, you're gonna see it more and more and more. It's like your friend's car that you've never seen before, but once you've seen it, you see it over and over again. Another example, if you type in meet spoofy on GDAX, so some of the strategies is like you can call it like market manipulations, and it's illegal in the financial market. But because the crypto is less regulated, it's still illegal, but some people have been trying to get away with it, including certain spoofing is like pretending you're gonna be making a trade and a big order where there's buy side, sell side, and then quickly withdrawing it. So for the average eye, think, oh man, there's large orders coming in, there's big demands, but it's really not the case. So this is another bot that you can find on YouTube, and there's a whole bunch of them. So what about the crypto bots that you can find on the marketplace? The marketplace whether it's Hash or Profit Trailer, Crypto Hopper, and Bunny Hopper, whatever they are, there's a whole bunch of them. There's at least like 30, 40, 50 if I've come across. And again, I'm not the expert in analyzing the exact function and how they work, but think about this. If you have the holy grail that from some of the trading activities I've shared with you from my inner circle, due to the law of compound interest, even if you just invest getting 1% a day and you compound that over the 365 days by investing $25,000 within 1 year, that would turn to over $1 million. If you get 2% a day, that would turn over to be more than $1 billion based on $25,000 you start off with. So if that's the holy grail that you're building, why would they share this with you for $50 a month? It doesn't make sense, right? So a lot of these bots, they may provide you with certain tech capability, but they haven't worked out the strategy, because the strategy is the difficult part on how do you program it to make it work. Some of them actually provide you the strategy, the arbitrage trading strategies, and pre-programmed as well. But again, if it's already working, why would they share it with you? And secondly, if it is working, let's just say this person is really generous and want to give it away, kind of like open source community. When everyone is onto it, you're not going to get above market average return. Where you get above market return rate that Alex talks about a lot, you have to bet against the consensus. You have to go against the trend of what everyone else is doing. When everyone is buying, you need to be selling. When everyone's selling, you need to be buying, or you need to be using a different strategy that nobody else is doing. And with the bot, what it does is it gives you 24 hours access. It can reach into so many different exchanges, so many different pairs that it can analyze. A human being cannot do that. It can work a lot faster. It is prone to less errors. And because of that, you can build a much more diversified trading scenario using different strategies in place that's working 24/7. But this world is changing. Gone are the days that you think that just the technical chart readers and fundamental is going to drive the days. The proof has already shown that the quant, the algorithm, the bots are taking over. So I hope that you've enjoyed the content. Does that mean that humans are gone? No, because at the end of the day, the bots are created by a team of humans. Not just a team of humans, but a team of the smartest human, the best mathematicians, computer scientists, traders, strategists out there in the marketplace. And as they say, if you can't beat them, you join them. So that's the path that I started exploring, going down, and it's been a great journey. So there's a lot more I want to share with you, but that's it for today. If you like what you see, please like, share, and comments. And if you have any experience with bots, I'd love to hear it from you. Or if you've got any questions, I'm definitely going to answer it myself. And if you're on YouTube, click on the subscribe button to get notification on the future videos. So have a great day, guys.